Welcome, ladies and gentlemen, to the Cima Strategic Case Study Financial Strategy or F3 Essentials Refresher Segment 6 Part 1. Right, so this is also another segment I'm going to deliver in two parts because there's important content to be covered. This part is on mergers and acquisitions and a couple of other deal type transactions that companies and corporations put themselves through. Let's have a look. But before we dive into the content, you know what to do. Do have a notebook and pen on the ready. Follow the slides and my explanations carefully. Take notes. Maintain a list of doubts and clarifications. Please do maintain a list of key topics that you feel you're weak at so you can self-revise later. Stay focused. You can take short breaks. A quick reminder on the core activity itself. You know that there are three areas. Now, mergers, acquisitions, deals, transactions that companies go through mainly associate with the third area here, recommending and applying business valuation models. But it also looks at the kind of considerations that senior financial managers have to do, because a merger or an acquisition or a divestment or any kind of deal for that matter is related to the investment decision. And if there is an investment to be made, if you are considering an acquisition, you are also thinking about financing it. So it relates to the financing decision. And ultimately, if you're thinking about investing and therefore you need funding, why you're doing it is in the best interest of shareholders, to maximize shareholder wealth. And therefore, it definitely relates to the dividend decision as well. So by all means, this is a very critical area as far as financial strategy is concerned for a senior financial manager. On that note, let's start. When it comes to mergers and acquisitions, actually it's this combination of all the kinds of deals that a company can go through by breaking apart or coming together: mergers, acquisitions, divestments, etc. When it comes to M&As, which I will refer to hereafter as M&As is mergers and acquisitions, we have to try and understand the regulatory aspects to it, synergy aspect, stakeholder considerations and tax implications. And as far as divestments are concerned, there is this very famous option of MBOs, management buyouts, which we will look at as well, and a little extra information that relate to all of this. Now, first of all, let's think about why a company would merge with another, or why bidder or an acquirer target to acquire another company. There are many reasons, like increased market share and power, economies of scale, combining complementary needs, improving efficiency, a lack of profitable investment opportunities like surplus cash, you have too much money, you want to do something with it, tax relief, reduced competition, asset stripping, and even harnessing big data opportunities lately, because in the modern day and age, you acquire another company with a lot of data, there's a lot of big data opportunities to be harnessed. And on that front, mergers and acquisitions can be classified to reflect the nature of the combined, of the resultant group. For example, you have horizontal integration when two entities in the same line of business combine. Then you have vertical integration, which results from the acquisition of one entity by another, which is at a different level in the chain of supply. Right? So if you acquire a business in the same line of business, it's horizontal integration. If you acquire a business or merge with a business that is in a different level in the supply chain of your business, then it's vertical integration. But then you can also combine with an entity or create a group entity which is in a completely unrelated business. Then the resultant large entity is referred to as a conglomerate. On that note, let's try and discuss a little bit about the synergy aspect. Now, synergy is a simple idea, right? As you can see here, this is often expressed as 2 + 2 is equal to 5, or how I would like to put it is 2 + 2 is greater than 5. So the simple idea is that the market value of a combined entity should always be greater than the individual sum of the individual entities put together. So it is important to note that synergy is not automatic, right? It doesn't happen automatically. You have to realize it. You have to work hard to realize it. In an efficient stock market, A and B will be correctly valued before the combination. And we need to ask how synergy will be achieved. That is why any increase in value, if at all, would should occur. Now, what kind of sources of synergy, or because we have to realize it, right? We have to extract synergy. From where can we do this? There are several reasons why synergistic gains arise, like operating economies, like economies of scale by combining the power of the two companies, elimination of inefficiencies in the processes, combining processes themselves can be very helpful. In addition to this, economies of scope, right? Then you have financial synergy, such as the reduced risk caused by diversification and other synergistic effects such as market power. Then we need to look at why a merger or an acquisition can fail, and historically we see a massive trend of M&As failing, right? One of the recent M&As I can definitely talk about is Walt Disney acquired 20th Century Fox, right? And they're still in the process of integration, in the process of really just putting all the assets of both the companies together, and then they're still figuring out how to realize those synergies, right? Which still hasn't really shown very positive momentum. And another example is how I think FedEx acquiring TNT Express. Another example is Sprint Mobile acquiring T-Mobile, I believe, in the US. So all of these are examples, right? Another recent example is very famous one where AT&T acquired Time Warner, right? Warner Brothers. So this was also a very famous merger and acquisition that recently happened. But why could M&As fail? The fit or lack of fit syndrome, where the two companies don't really fit well with each other. There can be lack of industrial or commercial fit, especially in vertical integration situations, lack of goal congruence, cheap purchases, urgent purchases, failure to integrate effectively, and the inability to manage change, right? Which largely deals with these last 2 points, largely deals with leadership. And on that note, we will look at a very important aspect, tax implications. The first one is the differences in tax rates and double tax treaties, especially when a company acquires another company based in a different country. There are likely to be different tax rates for the two companies in the group. Now, in order to help avoid double taxation between countries, the OECD has a double taxation convention with a commentary. So what happens is, whenever a double tax treaty is drawn up between two countries, the OECD model is used as a guide currently. The main function of any treaty is to avoid double taxation and to decide which country shall have the right to tax income. So let's say you're a company based in the United States and you acquire a company based in the United Kingdom, and now the UK based entity has generated profits and is going to send those profits here, but it has to pay tax of 10% there. The US corporate tax rate is 25%, for example. And then, you know, if the company based in the UK already paid 10%, as the profits are coming here, should the parent pay another 25%, right, when it has already been taxed there? Now this conflict is what, or this sort of unfair taxation, right, is what is treated through double tax treaties. Then there's group loss relief. Members of a group of companies may surrender losses to other profitable group members for corresponding accounting periods, right? So you have multiple companies, some of them make losses, some of them make profits. Those profits can be set off against these losses of the loss-making entities. Losses surrendered must be set against the claimant company's taxable total profits of a corresponding accounting period. Tax planning primarily seeks to ensure losses are used within the group to save the most tax, obviously, right? Everybody's trying to pay the minimum amount of tax. You know, for example, Amazon paid just zero tax, right? In 2019, there were major concerns about this. So group relief is only available for losses and profits generated after a company joins a group, and group relief ceases to be available once arrangements are in place to sell the shares of a company. This will usually occur sometimes before the actual legal sale of the shares. So group loss relief is one option that companies can use smartly. Obviously, they have to be very careful about it. They have to manage it effectively when they are part of a group. Withholding tax, that's another aspect. A withholding tax, also called a retention tax, is a government requirement for the payer of an item of income to withhold or deduct tax from the payment and pay that tax to the government, right? So it's a government requirement for the payer of the item of income to withhold or deduct tax from the payment and pay that to the government, right? In the context of groups of companies, withholding taxes need to be, so basically the entity is acting as a mediator in making sure that you withhold a certain amount of tax and then pay it to the government. In the context of groups of companies, withholding taxes need to be considered when one company makes payments to another within the group, right? For example, as dividends or interest on loans. Typically, the withholding tax is treated as a payment on account of the recipient's final tax liability, right? It will be part of the recipient's typically, right? That's the general treatment. You look at whoever is receiving the payment, and it will be treated as as a tax liability on the recipient's accounts. Next, you would remember in one of my very initial sessions, we understood that regulators are a critical stakeholder group. And among regulators, competition authorities play a key role. The role of the competition authorities varies from country to country, but as a general role, their aims are to strengthen competition, to prevent or reduce anti-competitive activities, to consider the public interest, and if the competition authorities find that a proposed merger or takeover is anti-competitive, they have the power to block that takeover completely. So be careful, right? Even in the strategic case study, if there's a merger and acquisition or some sort of intercompany or intracompany deal is going through, there is always that consideration, there is always the need as a finance manager to try and understand how would competition authorities look at this, how would they perceive this, and will they respond positively. They have the power to block the takeover completely or to allow it to proceed subject to certain conditions being met. For example, the combined entity might be required to sell off some of its retail outlets after the acquisition, right? Then we need to look at another option, another type of transactions, right? Company transactions, divestments, which is basically the disposal of part of its activities by an entity. And sometimes divestments are important because of some of these reasons or one or more of them. It could be that the sum of the parts of the entity may be worth more than the whole and you would want to divest and establish an individual entity, or you could be divesting unwanted or less profitable parts. There could be strategic change looked at, example, to shift the strategic focus onto the core activities. So you might already bearing a lot of weight of unnecessary or activities that don't directly relate or don't add any competitive edge to your business. You might want to divest it off, or as a response to crisis, right? Those are the key things about the divestments. You have to know what it means and why a company would consider that. Then let's take a look at, as a result of divestment considerations, one option is sell-off or a trade sale. A sell-off is the sale of part of an entity to a third party, usually in return for cash. The most common reasons for a sell-off are: one is to divest of a less profitable business unit if an acceptable offer is received. This could be through a management buyout even. Also, to protect the rest of the business from takeover. A part of the business which is attractive to a purchaser may be sold off to avoid the whole company being taken over, right? So, there are various defense strategies, right, when you're being targeted, and one of that is sell-offs. And to generate cash in a time of crisis. A sell-off may disrupt the rest of the organization if key staff or products from within the organization are part of the business unit sold off, right? So it can be a key disruptor. It can really trouble the momentum of the company itself, but all in all, this is one option that companies consider due to various situations and circumstances. Then another type of deals is definitely the idea of spin-off, right? You might have heard this, right? We spun off this segment, we are looking at a spin-off. In other words, it's called a demerger. Basically, a lot of companies that have merged and acquired are looking at demerging nowadays. In a spin-off or a demerger, a new entity is created where the shares of that new entity are owned by the shareholders of the entity that made the transfer of assets into the new entity. So that's as far as the ownership is concerned, but you are separating the entity, you are creating a new entity or spinning it off. There are now two entities, each owning some of the assets of the original single entity. The ownership has not changed, and in theory, the value of the two individual entities should be the same as the value of the original single entity in theory. But why would companies consider spin-offs? One is they allow investors to identify the true value of a business that was hidden within a large conglomerate, right? So there are plenty of businesses who like to, acquire small businesses for small values, right? Even venture capitals do this, and then look at the potential of that, try and put down the foundation, build that potential, build the momentum of gaining that potential, and then spin off and then dump the shares at massive prices, right, and make a profit. They should also lead to a clearer management structure, and they can reduce the risk of a takeover bid for the co-entity, right? So spin-offs are again another defense depending on the situation if you're being targeted by an acquirer. Then we can try and understand what MBOs mean, management buyouts. Now this is where a business is purchased from its existing owners by members of the management team, generally in association with a financing institution. So if you're in a company, you are a senior manager in the company, what happens is you get together with a few other managers and you buy that company from the current owners. It's most likely that you might work with a bank, work with a financial institution to secure the additional funding, which would lead to a sort of leveraged buyout. Considerations before an MBO. What would you look at if you were to consider an MBO? Do the current owners wish to sell? Because if they are not ready to sell, no way. Now, for example, I know that the Moody's Analytics Knowledge Services arm of the local operations based out of India was actually bought over through an MBO recently, just last year, and now is termed as Equity Knowledge Partners, right? I used to be part of their investment analytics team. So the current owners obviously wished to sell in that situation. Then the potential of the business, the loss of head office support, quality of the management team, because if the management team is highly confident and they know that they can run the business, they know that they can run it better than the current owners, then it's good time to consider an MBO, and obviously the price will be considered, right? If the price is too high, if it's not a fair price, then the deal might be off. How do you finance an MBO? Now in an MBO, unlike a corporate backed takeover, the acquiring group usually lacks the financial resources. So several institutions specialize in providing funds for MBOs. These include venture capitalists, banks, private equity firms, and other financial institutions. So we'll dive a little deep into understanding MBOs as well. Now, when it comes to the suggested capital structure of an MBO, capital structures are inevitably complex with several levels of risk and reward. Financiers tend to favor established businesses with reliable cash flows. They like definitive plans, but say they prefer them brief and to the point. So the emphasis is primarily on the competences of the team, of the management team which is buying the company, and the potential market opportunity there is to be exploited. So with a detailed analysis, obviously you can look at acquiring funding. Managers will be required to invest some of their own money, and this will take the form of shares with special features, for example, a high proportion of any disposal value. So if you look at the layers of capital structure, it will be initially secured borrowings. Well, let's look at it from descending order here. Equity holding will be granted to the MBO team. On top of it, you can have venture capital finance, then you can have junior debt or mezzanine finance, then you can have providers of senior debt coming from banks, and even further there can be secured borrowings, right? These are different layers of how you can establish the capital structure of an MBO. Then obviously there's the option of private equity, and as far as private equity is concerned, let's try and understand what they are and how they operate. Now, private equity is sometimes confused with venture capital because both terms refer to firms that invest in companies and exit through selling their investments. However, there are major differences between these two. Private equity firms mostly buy mature companies that are already established. The companies may be deteriorating or not be making profits they should be due to their inefficiency. So what happens is private equity firms buy these companies and streamline operations to increase revenue. Venture capital firms, on the other hand, mostly invest in startups with high growth potential. This is one key difference. The nature of interest that private equity firms show are a little different, or are generally different to venture capital firms. Then private equity firms often buy 100% ownership of the companies in which they invest. As a result, private equity firms are in total control of the company after the buyout. But venture capital firms invest in either 50% or less of the equity of the companies. Most venture capital firms prefer to spread out their risk and invest in many different companies. So if one startup fails, the entire fund in the venture capital firm is not affected substantially. By contrast, private equity firms prefer to concentrate all their efforts in a single company. Right? This is another key difference. Since they invest in already established and mature companies, the chances of absolute losses from such investments are minimal. Right? So, by nature of the interest, right? Who do you want to acquire? You want to buy established and mature companies, you want to acquire 100%. There we have a private equity firm. Then let's look at exit strategies for companies and corporations. Now, investors and financiers, right? They're the ones who would want to exist, will want to realize a profit from their investment in the medium term. Now, debt financiers will normally have a specified repayment date. Why medium term in this sentence is because you're looking at an exit strategy, and then comes the question, why would a company want to exist? Probably we're talking about exit strategy because they are looking at, leaving sooner than they were hoping to leave, right? So debt financiers will normally have a specified repayment date. So the debt providers will have a clear exit route, assuming the borrowing company has performed in line with expectations and can afford to repay the debt as planned. Right? That assumption is important. If not, they're going to stay and they're going to recover it somehow. Right? There's collateral, there's security. They have taken various measures. Debt financiers, you know them. For equity providers, the exit route is not as easy to identify. The most common exit route for an equity investor is the sale of the shares to another investor. This could be through one of the following methods. One is obviously a trade sale. When it comes to the MBO company, if they receive an offer for all its shares from another company, the financiers will be able to realize the investment. But in a trade sale, all the shares are normally acquired by the bidding company. So the management would have to sell their shares also. But they might not be very happy to do this, because the appeal of an MBO to managers is that they will own their own company rather than have to report to other shareholders. Right? So trade sales are not that simple, especially if the managers, the owners, the manager owners are being pushed to sell their shares as well. Then you can also obviously look at an IPO. If the MBO is successful, right? If it's doing really well and if it's attracting public attention, an IPO flotation on the stock market, which was introduced earlier as well, it gives the financiers who want to sell their shares the chance to do so on the stock market. Now, if the managers want to keep hold of their shares, they will be able to do so. But the problem with an IPO is that the company will have to satisfy very stringent criteria that I mentioned earlier, and there will be significant costs associated with arranging an IPO itself. Right? It can be very costly, it can be very effort consuming, resource consuming. You might really want to look at the cost benefit analysis of looking at IPO purely as a means of exit. Then obviously an independent sale to another shareholder. The managers could try to increase their shareholding in the company by buying out the other financiers. So if there is a venture capital firm and if they hold 40% of the shares and the rest of the 60% is with the managers, they might want to, as the company is growing and if the company is doing better and better and better, they might want to acquire that ownership of the VC as well. So in such a case, they could look at other options, which could be expensive, but if the managers can afford it, it would prevent other shareholders buying the shares and having a say in the running of the business. So these are 3 exit options, especially for equity investors associated with an MBO. That marks the end of mergers and acquisitions and related transactions like divestments, spin-offs, demergers, etc. and looking at various other capital structure, tax implications and key considerations. Do keep working while having fun. That marks the end of segment 6, part 1. I will probably see you soon with another segment. Thank you.